Hi, welcome back to another episode of the Balance Sheet Breakdown, a WilkinGuttenplan podcast. Today on the Balance Sheet Breakdown, we're going to be talking about the federal estate and gift tax exemptions which apply to every taxpayer. I'm Chris Frederick, a partner with the firm, and I'm excited to have back for our first reoccurring guests on the podcast, two of my fellow partners, Maureen Jasper and Brian Geissler, and they are the firm's leaders of our estate and trust group. So Maureen and Brian, thanks for coming back. Thanks for joining me again on the podcast.
Thanks for having us.
Thank you.
So maybe let's start with a bit of a baseline. Can one of you maybe explain what is the federal estate and gift exemption, and maybe what's the exemption amount today?
Okay, so first, technically it's called the basic exclusion amount. Most people just refer to exemption. So for our purposes today, let's just stick with the exemption. Simply put, the federal exemption amount is the amount you can give away during life or at death cumulatively and avoid any federal transfer tax. Currently for 2023, the exemption is $12,920,000.
And since our podcast is called The Balance Sheet Breakdown, it's appropriate for today because I just want to touch base on exactly what is your estate, right? So I don't want this to be confused with the estate income tax. So your estate is subject to the estate taxes, which is based on your net worth or your balance sheet as of your date of death, versus your estate income tax, which is the income earned on your estate. So kind of like your individual 1040, but when you pass away, your estate then pays an income tax. So two separate tax regimes. We're talking right now about your net worth or balance sheet as of your date of death for the estate tax.
That's a fantastic way to kind of bring it home. And I think that's a easy way to really differentiate, right? It's how much wealth you've accumulated. The comment was made, at life or death. What exactly does that mean? How does that work with the 12.9?
So, Chris, if you were to gift to me $12 million during your lifetime, you have the opportunity to do so.
Great. Thank you.
If you chose not to and you didn't want to gift that entire amount to me during your lifetime, at your death, you could then do it at that point in time. So whatever you don't use during your lifetime then carries over to your death. And then when you pass away, we take your balance sheet at date of death, and whether it's over or under 12.9 million determines whether or not you're paying a tax.
Okay, so that makes sense. It's a cumulative pool. Mm-hmm. If you don't use it during your life, it's what's there at death.
Yep.
And so Maureen, you mentioned a couple times that this is a kind of standalone separate tax. What's the tax rate?
So the tax rate, once you get past the exemption amount, is 40%. So it's a pretty hefty number once you get past the free amount. And
so that applies to both, say, my estate after I die and whatever gifts I give. It's the same.
Correct.
40%?
Yep. So if you gift over the $12 million during your lifetime, you'll be paying a 40% tax on top of that.
Maureen, 40%, does that apply to both the estate and the gift tax? Is there a difference?
Yeah, so the estate and gift tax is the same rate. It used to be called the unified credit system. So the credit is actually the tax on the exemption. So let's be clear, the $12,920,000 has a applicable tax to it. It's about $5 million.
40% of it.
40-ish. There's some fluctuations in the graduated rates. The unified credit is based on the tax, not on the exemption. But for our purposes, and most people like to think about exemption, so what can you give away, not what's the tax on what you can give away. It's
right.
Kind of ridiculous, but that's
right.
the way it works.
I care maybe less on how much I'm going to save. I'm to your point, Brian. Maybe I'm more interested in how much can I give away until I start paying tax. I'm maybe less concerned with if I pay tax on the money I gave away, what it would be if I'm not paying the tax, right? So being able to give away 12.9 seems like a good way to look at it.
Yeah, it's much easier.
Yeah, and so let me get this straight. Let's say I'm super rich, right? Maureen and I play the lottery religiously, Powerball. We're going to hit it one of these days. Yep. Could I only give away the 12.9 million? I mean, is there any before I start paying tax? Is there anything else?
So you have several different options. Most of our clients do what's called the annual exclusion gifting. So you could gift $17,000 to me instead of the $12 million. You could do $17,000 per year. You could give $17,000 to Brian, $17,000 to whoever else is out there. Let us know.
You're start cutting checks, right.
In addition to that, your spouse could also do the same. So in total, you can both gift $34,000 per year, and it doesn't eat into that $12 million exemption. Right. So in addition to that, we have what's called gift splitting. So if you just wanted to write the check, to me for $34,000, that would be acceptable as well. Then we would just do gift splitting between you and your spouse, and it would be deemed half from you and half from your spouse. So
on
a bunch
paper,
of different
it's written up
options,
to say,
right.
hey, it wasn't all for me. It's
Right.
And again,
for both of us.
the 17,000 is the current year annual exclusion amount.
Okay.
A couple years ago it was 15, then
Right.
16, and now it's 17 for inflation.
So that could be a lot of money, right? I mean, because it's essentially, I'm married, right? So $34,000 from the two of us per year. If knew that I was sitting on this pile of wealth and wanted to distribute it amongst 10 people, that's $340,000 a year over a decade's $3.5 million. I mean, when the total exclusion is 13, and I, without a whole lot of effort, can expand that another 30-40%, that adds up quick.
Correct, especially again with grandparents, especially
Yeah,
because
for sure.
grandparents give to their kids and their grandkids and their great grandkids,
Yep.
kids,
Yep.
and
Yep.
it adds up fast.
Are there any other maybe common exemptions that are available that we see people take advantage of?
Yeah, so a lot of our clients take advantage of what's called the medical or educational benefit. So
Okay.
you could pay directly the expenses of, let's say, a family member or a friend directly to the medical facility if they have significant medical expenses, and that doesn't count towards the 17,000 annual exclusion per year, nor does it count towards the 12.9 million. So that's one way to get some cash out of your estate and help a family member.
But to be clear, it has to be direct. You
Right.
can't pay
Okay.
the child or
Direct.
the person.
Right,
and
so-
then pay.
Right, you
have to
can't
pay
reimburse them.
Right. So Brian, if I want to pay your child's tuition next semester,
University of Tennessee.
I have to write the check to the
Same
University
thing
of
for
Tennessee.
educational, yep.
And my wife and I can still give your daughter another $34,000.
Correct.
So I can give as much tuition, medical expenses,
Yep.
and still give my spouse and I can still give away our $17,000 each.
Yep.
Correct.
And all of this doesn't eat into that $12 million we were talking about. So.
Right, which I mean that sounds like it can be some really big dollars. I love when we talk about these exemptions. They're obviously set by the IRS. Right now it's $12,900,000 and something $1,000. Why isn't it $13 million?
Round.
Right? Why can't it be nice and round?
Well, actually, it was. It's $5 million is the original number.
Okay.
And then Tax Cuts and Jobs Act doubled it. And with the $5 million exemption, it's indexed for inflation. So
Okay.
the $5 million ultimately, if it wasn't doubled for TCJA, would have been $5 million and change 1 year and then up a little more. And that's why we're at $12,920,000. That's ultimately the index for inflation.
Okay, right.
It's now $10 million index for inflation.
So 5 became 10, and then we've been adjusting for inflation for the past 4 or 5 years.
Correct. Yep.
Right.
Okay.
And since we were talking about TCJA, our Tax Cuts and Jobs Act, we know that is going to sunset after 2025. So we think it's going to be it's supposed to be the 5 million plus, index for inflation. So maybe it'll be around 6.5 million. We're not really sure yet, obviously, because we're not there. So something to definitely think about since that exemption is going to sunset. So estate planners will be busy at the end of 2025, doing all the planning. So, it's probably prudent to start thinking about it now so we don't have a fire drill at the end of 2025 trying to figure out what makes most sense. So it's a well thought out plan.
It sounds like it gets chopped in half. If it's 13,
Pretty
if it's say it's $14 million, easy
Right.
math, right? Nice round number. End of 2025, no change in legislation. That $14 million goes down to 7.
Correct.
Yep.
And that's a
At
big
40%, that's a big
that's
chunk.
a big chunk.
Yep.
Let's say I cut Brian a check for $14 million on the day before, right? Let me stress out my investment advisors. Let me cut him a check the day before this sunsets. The next day, right, 2026, it all of a sudden jumps in half down to $7 million. Will there be anything that the IRS is going to do to maybe try to make my exemption down to the $7 million, or?
So yeah, that's a good question. So people were severely concerned about that once this came up, and actually the IRS, they do have regulations that say that they will not have a clawback.
Okay,
Right,
before
yeah.
2025 to get the higher exemption amount, I can gift it all and not have to worry
Correct.
about anybody coming back for their
Correct.
40% of the $7 million,
Right.
which is a big
Yeah.
a big chunk. Are there any other long-term strategies people can do? I mean, take the 12 million 9 that it is today and transfer more of their wealth to that next generation.
Yeah, there's lots of ways to do it. If you're charitably inclined, you can have CLATs, CRUTs, you have GRATs and GRUTs. There's lots of things that you can do to get these assets out of your estate before you pass away.
Right, and we talked a lot about, gifting to children and or grandchildren. We didn't talk about generation skipping transfer tax, but that's another layer of tax that could be on top of the 40%. So there's, planning that you can do with trusts that if you don't want, assets to get into the hands of either a minor and or someone that may not be as mature to handle a significant amount of money. So you can do that planning and protect the assets, as we call them, creditors, predators, and the beneficiaries themselves. Get that wealth out of your estate, but then also preserve it for family when they get older.
Without having to chop the 40% off the top.
Correct, right.
And so I mean, it sounds like a lot of that has to do, though, with making proactive and smart choices on your estate before your death. So Maureen, I think you mentioned it, right? Between now and the end of 2025, when the exemption gets slashed, having a good look at your trusts, what you've got, what your wealth looks like, whether it's making gifts, putting in trusts, but understanding what you have and what the future tax liability could be, sounds like an important step.
Yeah, communication with your, CPAs, your financial advisors, your attorneys. Everybody should be on the same page, communicating and coming up with what plan makes the most sense.
To me, I think the takeaway is making smart, proactive decisions before death allows you to really see that as much of your wealth as possible can be handed off to the next generation and keeps maybe more out of the pocket of the IRS.
Yep.
Yeah. And since you mentioned just the IRS, every state has a different rule with regards to whether or not they have an estate tax. The lovely state that we live in, New Jersey, does not have an estate tax, but to Brian's point, there is an inheritance tax, so we always want to keep that in mind as well when we're planning.
Like anything with state taxes, every state has their own way to do it. And maybe our state is more higher rates compared to some others, so that all the more reason to have
A plan in place.
That's great. Thank you both for joining. This has been Chris Frederick of the Balance Sheet Breakdown, a Wilkin & Guttenplan podcast, helping you make sense of the numbers.